Hey everyone, welcome back to Bonds with Bunt. This week we've got a really interesting disconnect happening in the market. Oil prices spiked, mortgage rates jumped around, and markets are reacting to geopolitical headlines. But at the same time, the jobs report came in extremely weak, home sales beat expectations, and buyer activity is actually starting to increase. So today, I want to break down what the market reaction may not match what's really happening underneath the surface and what that means for housing right now. The biggest driver in the market this week has been oil. Tensions around the Strait of Hormuz pushed oil prices sharply higher, at one point nearly doubling from where they were not too long ago. When oil jumps like that, markets start to worry about inflation again. And when inflation fears rise, mortgage bonds fall and rates can move higher. But here's the key thing to understand. Markets tend to overreact to geopolitical shocks in the short term. We saw this after the attacks or the Hamas attacks in 2023. We saw it during the Iran tensions in 2020. Oil spikes, market reacts. Then once the situation stabilizes, oil prices usually settle back down. We actually started seeing that this week as oil pulled off its highs. Now let's talk about the jobs report, because this one was pretty shocking. The economy actually lost about 92,000 jobs in February. That's far weaker than economists expected. And when you include revisions to prior months, job growth was revised down by another 69,000 jobs. That's a big shift. The unemployment rate also ticked a little bit higher. The average length of employment now is the longest we've seen in about 4 years. All of this suggests the labor market is weakening faster than the headlines suggest. And historically, when the labor market cools, inflation pressure tends to follow. Now, here's the part that's getting almost no attention. Housing data actually came in stronger than expected. Existing home sales rose to an annual pace of 4.09 million homes, beating forecasts. Inventory is starting to rise slightly as we head into the spring market, but it's still well below pre-pandemic levels. And that's why home prices are still expected to increase around 4% over the next year. At the same time, mortgage applications continue to rise. Purchase applications are now up 11% compared to last year, which tells us something important. Buyer demand is extremely sensitive to rates. Even small improvements bring people back into the market. This interesting setup right now is this. Markets are focused on short-term volatility from oil and global headlines, but underneath that noise, the labor market is cooling, housing inventory is still tight, buyer demand is quietly improving, and as we move into the spring buying season, that combination could surprise people. Housing markets tend to move quickly once confidence returns. So the big takeaway this week is this. Markets are reacting to headlines, but the underlying data tells a different story. The labor market is weakening, housing demand is improving, and the spring market is just getting started. If you've got buyers sitting on the fence, this might be the window before competition starts picking up again. As always, if you want help running numbers or talking through strategy for a client, just reach out. And I'll see you next week on Bonds with Bunt.